The people working in DeFi and like AI stuff are like a million times more competent than the people working on CBDCs and digital dollars. The disparity between the level of talent between the two is so large that it's really hard for me to imagine these government currencies really taking off.
Very few people like you are running the numbers and even looking at the blockchain, which is public information, but most people don't do that, right?
They will have to think a lot about this sort of risk and incentive management. And there's two camps of viewing this. One is you start doing that at the onset, but then you kind of grow more slowly. And the other is the Ohm model of get as much liquidity in the door as possible and then fix it afterward. I think they both are valid ways of growing. I think it's more about understanding your user base in that case and like what you're thinking through who your user base will be in the future. The progress made has actually been quite astounding in terms of like even just getting to the point of having governance, getting to the point of like automating a lot of features of things in finance that quite frankly normally are done by lawyers. When I was graduating college, like the cool thing was always to go into AI stuff, and everyone at the time was like, oh, like there are these AI companies, they'll like do tons of awesome research, but like they'll productize it and find a way to be a viable business. If we look back 10 years, right, DeepMind, OpenAI, places like that did not figure out how to monetize. They had to basically get added to like one of these big companies. But you know, my dream is that we find, you know, we're one of those, but with a business model because it's crypto.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go? This is London Real. I am Brian Rose. My guest today is... This is London Real. I am Brian Rose. My guest today is Tarun Chitra, the mathematician, blockchain technologist, and decentralized finance thought leader. You started your career in 2011 at the global investment fund D.E. Shaw, known for developing complicated mathematical models and sophisticated computer programs to profit from anomalies in the financial markets. Then, in 2018, you became the founder and CEO of Gauntlet, a simulation platform for crypto networks that helps developers de-risk DeFi to better understand the importance of security, governance, and consensus mechanisms. Gauntlet provides cutting-edge, real-time analytics to DeFi platforms like Aave, SushiSwap, and Thorchain to help make their products perform better, mitigate risk, and allow for scalability. Tarun, welcome to London Real.
Great to be here. Thanks for having me.
Thanks for being here. I tried to kind of outdress you with colors today, but clearly I've failed. You usually win on that one. I saw you on stage at the Token 24/9 conference. I think you were next to Stanley Kulichev, and you guys had a great conversation, so I'm really looking forward to this. I have to start by confessing that I couldn't get a job at D.E. Shaw when I tried. I was at MIT, and I tried to get a summer internship there, I think in '92, and they sent me a rejection letter. But later I went to Bankers Trust and worked on Wall Street and got a kind of probably a different type of vibe than I would have had there. Obviously, I think Jeff Bezos famously worked there before he started Amazon in '94. So much to talk about, Tarun. I'd love to start off a little bit, maybe with your first 5 years on Wall Street, because when I look at Gauntlet, it seems like a strange combination of everything you learned at Cornell and maybe some of the things you picked up at D.E. Shaw, and then all the other things combined. So maybe we start there. What do you remember from those days on Wall Street, and was D.E. Shaw an important part of your career?
Yeah, for sure. I think maybe the way I will color this is I'll give a history of how I got into crypto, and then along the way, like that, I'll give a little bit of kind of the finance type of stuff that was
sounds good.
Kind of there. So I was working at D.E. Shaw Research, where we are actually building ASICs and custom hardware for a bunch of different reasons, not for mining, but for totally different use case. And basically what happened in 2011 is we had this $25 million chip order. And basically we gave $25 million to the supplier, and then they ghosted us for 6 months. And then of course they came back 6 months later and were like, hey, we'll give you a 10% discount. And of course, maybe slightly more politely than this, we said, fuck you. Like, why did you have to tell us what happened? You know, like, where is this, where did our money go? And, they were kind of reticent to tell us what really happened. But after, twisting their arm a bunch, they told us it was like someone doing cryptocurrency mining. And in 2011, that was just like unheard of, like that someone would be going to the process of building hardware to do mining. So that had me starting to mine a bit, which I took all the coins I earned then and sold them at the bottom in 2013. But it definitely got me into the space a lot. And I think what happened in sort of like 2015 and 2016, the academic research on cryptocurrencies got a lot better. So I think when I was at D. Shaw and also when I was in high frequency trading, most people I worked with were people with sort of like traditional distributed systems backgrounds. And one thing that's interesting about, Bitcoin, or the early days of Bitcoin, is that basically no one in distributed systems believed it was really working until it like existed for like 4 or 5 years. And one of the reasons for that is that there's a lot of like incorrect math in the original white paper, and it doesn't really kind of prove the claims that are made. But then also B, there's just a lot of like existing sort of theory for like how distributed systems work, like how distributed system that's like in a data center run by Google or Apple, like how all the computers there talk to each other. A lot of those properties only hold in sort of like a probabilistic way for cryptocurrencies. And until basically 2015, no one actually gave a very good description of why or how that occurred. So I think once that started getting a lot better, like the academic there started to be like, hey, there's actually like a way of wrapping your head around these things. I started reading a lot of papers on new protocols, especially like proof of stake protocols. And one thing I thought that was interesting was that a lot of the stuff was written by cryptographers, and they would focus on, hey, like, does this cryptographic assumption break? Like, does some mathematical property like not hold? Whereas, when you're coming from finance, you think of things in terms of like, what is the likelihood of this event happening, or what's the likelihood of users, traders, market makers, whatever, changing their behavior, and then suddenly the system breaks because there's no one there, or someone's doing something malicious. And I kind of noticed that these papers, the security models they used were really focused on these kind of like cryptographic assumptions and not user behavior assumptions.
Right.
And that led me down the rabbit hole of trying to take a finance lens to these different protocols and sort of try to understand if there are like financial attacks that would basically cause all the users to sort of like leave in some sense or take over the network. So that's maybe a longer winded answer.
That helps. Do you think you got that perspective from like being at D. Shaw, where understanding risk and capital at risk and markets was so important? Because at Cornell you're studying mathematics and physics, and it's, again, like you said, it's very easy to go down that cryptography rabbit hole and go analyze it that way. But the perspective from a risk management perspective is one that's not obvious to a lot of people unless maybe you've worked in a firm that lives and dies by P&L and risk.
For sure. I think D. Shaw helped me more on the like understanding cryptocurrency research side of things, because they're much more focused on sort of the rigorous research aspect of how they think about both risk and modeling things, etc. But I think when I worked in high frequency trading, that's where I got the real sort of idea, the sort of kernel of like, oh, actually, we should be thinking about these cryptocurrency systems the way high frequency traders think about risk. It's like much closer to that, where, HFT is extremely adversarial. It's like very zero sum. You have like, 10 firms, and then, a whale makes a big trade and everyone is fighting to kind of like be the one providing liquidity around it, right? And that is very similar to like how a lot of cryptocurrency networks behave. And so I think thinking about it the way traders think about it, and I really mean much closer to automated high frequency traders, less like the sort of most of the stuff D. Shaw does, or like these bigger asset managers, Renaissance, etc. They don't do super high frequency stuff. It's sort of like medium frequency and very large size. Like they have, $1 billion portfolio and they rotate it into different assets every week or something like that.
Right.
Whereas in high frequency trading, it's much more like, you do a quick trade and you don't have that much capital at risk, but you're sort of like attacking the system in some way that looks more like what cryptocurrency attacks look like. So I would say I learned more about thinking of this type of stuff from HFT than from sort of like D. Shaw.
Can you give everybody here kind of like high frequency trading like 101 in like a couple minutes? Because you mentioned some interesting things about it. Again, it probably gets a really bad rap in the market and people probably don't understand what it is and what you can learn from it. But how do you kind of explain like what it is to most people?
Yeah, so I mean, I think the simplest way to think about it is in a market, if prices are really stale, if there hasn't been a trade in a while, then it's really hard for people to trade a lot of size because there's sort of uncertainty, like, no one has really wanted this asset for a while, so maybe it's worthless. So in order to actually ensure that markets have very recent pricing, you need people who are posting liquidity, who are adding buy and remove orders, almost like wholesalers. Like, hey, I'm willing to sell you this crate of grapes at $1 and I'll buy a crate of grapes at 99 cents, right? They're sort of like the middlemen who kind of provide inventory. And one important thing is like you want your inventory to be adjusting as fast as possible, because like if you don't adjust your inventory, let's say the price of oranges crashes 10%, now you're stuck holding a bunch of them and like you're getting out of them at a huge loss. So high frequency trading really is about inventory management at a really fast scale so that prices are incorporating as much information about supply and demand as possible. The reason I guess people have a negative view towards it is everyone thinks they're sort of like, being front run. But the thing is, it's an extremely competitive game. So to the point that it has, the fees and sort of profits from it have like shrunk quite dramatically over the last 10 years per trade. But it's basically a way of people doing inventory management, that you could think of it really like they're a wholesaler, but they're a wholesaler for this like asset that exists and, that they're adjusting the prices of really quickly. Right. The reason I say it's HFT, the HFT mindset is closer to the mindset to think of for security and blockchains is because in most trading is fully autonomous. There's sort of you have these algorithms that are sort of competing with each other, and most of the way that people interact with doing different trades is that they maybe interact with multiple venues. So maybe there's an asset in New York or really New Jersey on NYSE that's supposed to be correlated to an asset in Chicago. In Aurora, it's the CME. Well, then the high frequency trader sort of has two computers on both sides. They see one price change and they go and update their price on the other exchange. In blockchains, you have a lot of that because there's tons of exchanges and there's also tons of chains. And so you have liquidity sources that are on chain and you have liquidity sources off chain, and you have to synchronize all of those to get, kind of like the best information into pricing. And in that sense, it's much closer to HFT than something like statistical arbitrage, where you're like, I just want to buy Pepsi just went up 10%. I just want to go buy a bunch of Coke. You're not actually like saying how much you care about the price as much as you're saying, I know these two things are correlated. And when Pepsi goes up, Coke's stock price goes up. So I'd want to buy as much as possible, right? It's not so sensitive to like the little like, hey, the price of this moved 1 cent here. I need to move the price 1 cent there. It's a little less fine grained. And blockchains have a lot more of the latter than they do of the former.
Okay.
If that makes sense.
So that was probably some of your best preparation for what you do today is the high frequency stuff, because it probably taught you more about what's going on in the blockchain. Most people don't come from that background, so they don't look at it maybe through that lens.
Yeah, and one of the biggest things is that the way you measure risk, and this is true for stat arb places like DShaw as well as high frequency, but it's way more you live and die by this in high frequency, is back testing and simulation. So stress testing your strategies against historical market data, but then also, and this is something you do in HFT and not really at all in stat arb, is you make models of other parties who are either trying to compete with you or are like, the whales who are trading. And then you run simulations where you like look at how when these two bots are sort of competing, like which one wins, your bot or the other one. And then you try to adjust your strategy to beat the other one. And that is a very like blockchain security mindset in a lot of ways.
Okay.
If that makes sense.
So that's
you're
why
like thinking about, yeah.
Right. So it's just game theory and game playing against what could happen and scenario analysis and the other people out there that might be doing the same thing you're trying to do with arbing. And I guess that's why you started Gauntlet, because you could look at then all of these blockchain platforms from that lens and do all the things that none of these DeFi developers were maybe thinking about because they were trying to build a platform. And you were thinking, well, I can do all of this risk analysis and do all these simulations. And I guess that's what Gauntlet brings to the table to all of these big DeFi platforms. Is that right?
Yeah, exactly. I mean, one other thing that I thought was cool and that kind of what made me want to leave trading for this space is that all of the data is public, A, and B, all of the identities are public. So in HFT, when I was talking about, hey, we're simulating the game theory and I model my strategy and I model the opponent's strategy and then I run these simulations, I don't actually know the opponent's strategy. I'm guessing, I'm trying to think as if I was them, right? So it's like, trading in the 1970s, I have two parties and I have one person trying to think how the other person thinks about something and then try to be before or after them. Trading in the 2000s, like I have a bot, you have a bot. I have to think about how you would have written the algorithm for your bot and like what type of math tools you might be good at or might be bad at, and then try to make my bot identify that and then compete. In some sense, you're still guessing a lot in traditional finance because you don't have the data of the other person's strategy. You just like, you go out and you trade and then you see like the results, and based on the results, you say, okay, like they're probably doing this strategy. They probably wrote this algorithm because it seems very similar to what I see in simulation, what you see in production. In blockchains, you don't have to do as much guessing because the data is actually fully transparent, at least for on-chain things, not centralized exchanges. So there's less of this statistical inference problem and more of a like, how well can you replicate their strategy exactly, exactly to the T. And so that's what we really focus on, is making sure that our simulations, our models of these agents replicate people's behaviors and practice as well as possible. And one other difference I think that's important to bring up in DeFi is that in traditional finance, you have these counterparts that you trust. You trust the exchange, you trust the CME, you trust the NYSE, the New York Stock Exchange, you trust your bank, but to some extent. But here you don't. In fact, you rely on arbitrageurs and people like liquidators to be able to earn a profit in the system to do the function that the centralized entity would do. So like if I go on the CME and I trade ES, and then which is like the S&P 500 future, and I get liquidated, so like I took too much leverage, my position's underwater, the CME does the liquidation, right? Or FTX in the centralized exchange does the liquidation. But in DeFi, what you have to do is you have to incentivize people. You say, hey, here's some profit. People compete to do the liquidation, to make the system safe again. And that part is quite unique. In trading, when you're simulating things, you're really modeling, little traders, medium-sized traders, and big-sized traders. You're not modeling the counterparty risk of the CME. You're kind of like the CME, I will sue them if they mess up, right? Or something like that, right? Yeah. Here, you're modeling many different types of users. You're modeling the traders, the lenders, the borrowers, and the liquidators, arbitrageurs, people who are keeping the system safe. And so it's way more complex because of that, even though the data is more transparent. So,
yeah, look, this is a super important point. And, so I've got about 500 students that are in my DeFi Academy, and I push them in to experimenting with these DeFi protocols. So they have to, do a swap on, a protocol like Aave. They have to execute a liquidity pool so they can at least have a sense of what's happening. And when they look at something like Aave, you don't see all those risks that you're talking about, right? They see I can lend Ethereum or borrow Ethereum, et cetera. But you're not going to be able to tell, like you said, all of those risks out there that are almost unquantifiable. When I traded on Wall Street, like you said, when I did a contract with the board of trader, the mercantile exchange that merged later, that was pretty good credit risk, right? They were good at what they did. They would do margin calls. You knew where they would be there. When it came to the trades we did OTC, we would post nothing. There was no information out there because that's how we made our money. But also the counterparties were highly reliable because they were all banks, AA rated, single A rated banks. And of course the Fed's watching everybody. We got risk committees that are coming down trying to watch us. They do a pretty good job until something comes along like a black swan event, and then it goes out the window. But now you've got DeFi, where you've got markets that look similar, but like you said, there are all these different risks out there, and very few people even understand what those risks are. And maybe that's where you come in.
Yeah, exactly. Like the idea of using simulation in high-frequency trading, one other thing that's actually a thing that it's very useful for is giving you some notion of interpretability. So you might make a strategy that's sort of this abstract math strategy. You take some signals, you construct some, prediction based on a signal. And then if the prediction says very high probability of something happening, you go do a trade. That's very abstract. You don't know what the economic reason it's doing something might look like. But if you run many simulations, then you start looking on average like, oh, it tends to be that this algorithm I wrote is really capturing the fact that there are a bunch of ETFs that are actually buying around the times I'm trading. And you can go back and get some interpretability for what is actually happening. And so that is actually one of the more powerful things I think of, if you design these systems correctly, is you can get a lot of interpretability for the risks. You can actually have a better handle on what the intuition is. And that's sort of what we're really focused on, is using simulation to make those things crystal clear. But one other thing is it's not just mitigating risk. It goes both ways. So the other way it can go is improving capital efficiency. So when the market is actually not super volatile, if you're an exchange like an FTX or CME, you will basically say, hey, we'll let you put less collateral up, right? DeFi protocols have to somehow adjust to that, right? And that's the other side of the risk coin, is when it's not risky, you can actually offer better loans or better sort of forms of leverage in these systems. And that's clearly one of the things that DeFi is lagging in. And, I think that's what we're focused on, helping people do that in a way that is safe. Because you can do that and then completely blow up. And we've seen, I don't even know, tens, 50, hundreds of incidents where at the expense of risk, people gave you good capital efficiency.
Yeah. And one of my students asked me the other night, he said, well, if I'm lending my coin out in Aave, then, at one point, does it get liquidated, or how much collateral do I have to hold? And I kept thinking, well, Tarun usually comes up with that number, because you've done all the risk analysis and simulation. And if you go to your website, you can see kind of your I think, real-time look on a protocol like Aave or Compound, and you can see each kind of instrument, recommended levels of collateral, and versus what they're doing. And like you said, it's not always about being too safe, because then you're not maximizing liquidity or capital efficiency. And that's what you guys do. Can you walk me through even a use case of something you've done for Aave or Compound where you could explain it to someone? Like, for example, we looked at this and we found out that this was this, and then we recommended they do this. Is that a good way to explain to people more of what you do?
Yeah, sure. I think the simplest examples are things actually that are revenue related, which is in these protocols do collect some revenue for the DAOs. So they collect some fees based on borrow demand. Now, one question you might ask is what are protocols supposed to do with these fees? Well, they sort of act as a capital buffer, sort of like pseudo insurance. I wouldn't call it totally like insurance, but that revenue that the protocol generates is sort of value generated for token holders. And one kind of important thing is that we make recommendations of how do you improve the capital buffer? How do you increase the revenue for the protocol without reducing borrow? And there's a couple levers for doing that. One is changing the collateralization ratio and the amount of interest collected. So maybe you increase you say, hey, you can take a riskier loan. You can put up less collateral, but the protocol is going to take a higher percentage of interest as a capital buffer, again, to kind of control for liquidations or control in the situation where you have sort of like cascading liquidations. And, I think in a bunch of different cases, we've been able to like increase the revenue for these protocols by, like single digit plus millions. Hopefully over time, like that increases quite a bit. And the idea is that once you're really like increasing the revenue the protocol has, and also over time improving its like insurance buffer, its capital buffer, then you can start offering more risky sort of parameterizations. But that's the type of thing that we spend an inordinate amount of time really we have the platform that sort of ingests data from many different blockchains as well as centralized exchanges, tries to analyze and categorize different borrowers and look at like, hey, this like really risky borrower just joined the protocol. Like, given that they joined like under the current settings, like what's the likelihood that if they defaulted, they would cause a bunch of other people to default too? Things like that. We have this like sort of automatically triggered watching the blockchain, running the simulations, and then when there's something more adverse, go and send out the proposal. But I think, building the infrastructure for that and making sure you can do all the monitoring, automatically run these simulations, running tens of thousands to hundreds of thousands of simulations a day. And then from running those, trying to say like under these different parameters, like, hey, if we increase the collateral factor by 10%, and then reduce the sort of revenue taken earned by the protocol, what's the expected sort of safety value at risk and stuff like that. And so that's the type of stuff we spend a lot of time doing in a way that is similar to how people in high frequency trading optimize their strategies, except we think of the DeFi protocol as doing a strategy. It is a trader, right? It's trying to execute some type of strategy. Yes, it's trying to be delta neutral or trying to have certain types of risk properties. But it's a strategy that needs to be optimized as a function of market data, user data, et cetera.
And what's been your biggest, I guess, learning or surprise, say, in the last 12 months? I mean, obviously, these markets have rapidly accelerated since, I guess, like DeFi summer of 2020. Well, maybe walk me through that, and even maybe the last, 3 years since you started, because the market's changed massively.
Yeah, I mean, so when we started, it was basically almost about to be the bottom of the bear markets, like 2018. And the interesting thing was back then, I really, really, really thought it would be proof of stake protocols that really had this financial risk, because that was how I sort of fell into this. Part of the reason for that is that, if you were to try to execute an attack on a proof of stake, proof of work protocol, like Bitcoin, where you try to basically borrow people's miners in aggregate over the whole world, you would have to effectively corner the electricity market for it to be profitable, because you would basically need to go to every miner and be like, hey, we're going to sell you this derivative where you deliver hash power to us at some future time, but we will give you cheaper electricity, whether that means, we sold you oil or we sold you a bunch of futures, things like that. But in proof of stake, that's less true. The market for it is much more centralized in the sense that there's a small number of venues. The stakers want to earn yield. That's why there's this crazy explosion in staking derivatives, which, I think I maybe wrote a paper on it a little too early before it kind of like became super popular. But like I think this idea that stakers really want leverage and yield means that they're more easy to coordinate to do an attack. And in some sense, that was how I got into this. I think the thing that really changed my mind and needed me to warp my finance brain was Uniswap first. Because, I think to someone who worked in trading, especially in, more adversarial trading, like high frequency trading, Uniswap liquidity providers, naively, it seems like they're getting a terrible deal, right? On every trade, they are giving up the asset that's going up in value for the asset that's going down in value. And they don't like adjust their strategy. They take a tiny fee, but like, hey, maybe it doesn't work. But seeing that work in practice and seeing liquidity providers actually keep their liquidity there for a long time when we were analyzing their data in 2019 is what led us to sort of write, probably the most cited academic paper in DeFi right now, which is on why Uniswap works. But I think that was like the first surprise to me, but it made me realize there's this huge demand for passive investment products, kind of like there was in like right after the financial crisis, where like ETFs grew from like sub $100 billion to like this like multi-trillion-dollar asset class. And like watching the evolution of that, of like, hey, people really do actually want these passive products, like staking products. Staking products are kind of like the new ETF. They're like Gen Z's ETF in my mind, in some weird indirect manner. And that part has been super interesting to see. In terms of like the non-DeFi stuff, I'll be the first to admit I don't totally understand profile pic NFTs. It's just not something I have a great understanding for. But I do think this idea that NFTs serving as a form of sort of pseudo identity, not like strong identity, but some form of identity, will interact with a lot more of DeFi and sort of bring us different types of products that might be more risky, but like, you're able to offer them because you have some kind of identity wrapper around someone.
Yeah, on that same note, I was speaking with Yatsu of Man and Mocha Brands, who's in Hong Kong, and I was talking to him, I think, last week, and he actually credited DeFi with the explosion of the metaverse, because he said if it wasn't for the DeFi and all the borrowing and lending protocols, then they wouldn't have the liquidity or the demand that they have. And I was very surprised to hear someone in the metaverse say that. Do you agree with that? Do you think the metaverse will also come around and change the DeFi markets?
That part I am not totally sure yet, but I would say the first part about DeFi kind of leading to the NFT boom is 100% true. So I think a lot of people who made money during DeFi summer rotated a lot of that capital into NFTs, and pretty aggressively. I would say like a lot of the run up, the first run up, sort of like the NBA Top Shots post DeFi summer run up in NFTs, was driven by people who were kind of successful at DeFi summer. And then I think the second run up in February was started more by DeFi off Ethereum on Polygon and Solana and AVAX. I think Avalanche might be a little later actually, but definitely Polygon, Solana early, and then Avalanche later. But like that led to another kind of wealth effect of people got rich off of that and then put it back into NFTs. So like I feel like there's a cycle of like something people make a lot of money on it, and then they recycle that money to the next thing, and then there's sort of the next generation of people who kind of made money on the next thing and they recycle it, and there's this kind of like weird capital wealth effect thing. And I think one thing that's interesting is in these communities, if you can, one of the stickiest things for developers is basically you make a protocol that kind of gets all the developers who are the first developers on there super rich, And then they quit their day job, and then they start a protocol, and then they stay in your ecosystem pretty captively because they got rich there. And I think that's something that, differentiates maybe like Solana and Avalanche from, say, Cosmos and Near, because there are just not as many people who on Tezos, like there's just not as many people who kind of got squad wealth or whatever the current phrase is out of that, and that doesn't like lead to your ecosystem growing, and then there's this huge cycle. But yeah, I think DeFi led to NFTs, which led to sort of DeFi on other chains, which led to like the bigger NFT boom that we saw.
And while we're on NFTs, I guess I'll finish out with that. I mean, you're right about who owns. I mean, we had Stanley Kulichev in the studio, and he has like 2,000 NFTs, and he was showing me on his phone, and he's like, I've never sold one. And he said, Brian, we want to finance these some days the same way we finance fungible tokens. And it's a pretty bold aim. Do you see that happening anytime in the future? Will you be doing analysis with NFTs, or is by definition what you do have to be with something highly liquid like a fungible token?
Yeah, I mean, so one of the reasons actually, I run this sort of small fund with Robert Leshner called Robot Ventures.
Yeah.
One of the reasons actually we were sort of the first investor in a company called Fractional, which does fractionalized NFTs, is that I do think that the borrowing and lending markets for the NFT world will be quite different than the purely fungible world. But fractionalization is sort of a nice bridge, because it allows you to kind of use the existing mechanics provided there's like enough liquidity from the fractions. And I think fractionalization will be kind of an interesting tool over time, especially as we've seen people have these like collective ownership of NFTs. And that I think will actually be able to get into risk products. I think the other type of product will be a little more like a derivative, like a pure derivative rather than fractionalization. But yeah, I think financing NFTs is very similar to real life construction financing and large project financing. So it is the thing that resembles the majority of capital work that happens in the real world, because yes, over collateralized lending like Compound and Aave is very popular in the real world, right? Like home equity loans, or like people borrowing against their real estate. But it's not that big as a percentage of the market, right? It's like sub 5%, right? Something like that. If you add securities loans, it probably goes up to like 15%. But the rest of the market is really things like bonds, things that are like more unsecured credit, things like that. And I think NFT finance gives you the promise of bridging the gap of the other 85%, but for digital goods.
Okay, that's a really good perspective on that. You mentioned Uniswap, and maybe we should spend a little time on the phenomenon of Uniswap. And like you said, when you first looked at it, you were not necessarily convinced that the small amount of premium you get as a liquidity provider would allow that platform to thrive, and it has. I mean, it's probably changed everything, and I don't know if anybody saw that coming in 2019. Maybe you did. But it's something I try to explain to my students, the cost of liquidity, and it's really hard. When I was at Bankers Trust, my job was to quote, fix floating swaps to these institutions that were speaking with our sales team. And I was going down to four decimal places on a swap. So again, it was fixed floating, and it was a 6-year term, and your rate is 5.6431%. And if I was off, I got nailed. And that's what happens to market makers. You get nailed if you're off, and you take the hit. But of course, you make the bid offer when you're not. And the closest thing I saw was when I go to visit Chicago, and I'd see the 300 American football size player guys screaming in a pit who were creating liquidity for the market. That doesn't really exist anymore in a physical sense, but they were being paid to basically make two-way markets, even though big whales were coming in and the funds were coming in and Goldman Sachs was over here. They saw the information, but they only made that bid offer, and it was really hard to quantify the value of the liquidity. And that's why when I saw what was happening in DeFi, I was like, wow, they found a way to actually pay you for liquidity. It was kind of mind-blowing to me, because this never existed in the traditional financial markets. And maybe you can expand on that a little bit. And like you said, it's not about theory. It's really about practice, and do people do it, and does it work? So tell me your thoughts on that. And yeah, do you agree or disagree with any of that?
Yeah, I agree. I mean, the adverse selection cost you're describing is like very much a real thing when you're doing trading, right? At the same time, it took me a while to realize that there's, the LP shares are more like ETFs than they are like liquidity provision on Uniswap is a little bit more like an ETF than it is like I'm a market maker. And I think like from a sort of profit standpoint, and it took us about a year to prove like the mathematical formalism for like how you get to that, and like how you can write the math out to show that it looks like an ETF. But it because of that, if you flip your mindset to something where it's like, oh, I actually just want exposure to these two assets, and I know I'm going to pay some holding costs, but I also don't really want to think about which direction I'm holding at the end. I just I probably want both of them in some proportion. Like the Uniswap or balancer model actually just does kind of make some sense. I think the other thing that's important to note is that there are a lot of people who are more sophisticated liquidity providers, especially nowadays. And they really do migrate their capital from pool to pool, trying to optimize yield. And I think that there's the fact that there's like a spectrum between the like super professional and the people who just want the passive exposure like an ETF. It does resemble the normal market in a very similar way to how high frequency trading kind of like flatlined while ETFs bloomed, even though ETFs in some sense are kind of a money losing asset to hold. There are a lot of ETFs that you can go find that don't track the index. The thing they're supposed to be matched to, they don't track, because like every time they make a trade, there's like 5 hedge funds that have some model of like how to predict when that ETF rebalances, and they front run them, right? That happens all the time. Like I guarantee you that's like 50% of like large hedge funds that do that type of stuff. And there's just so much demand for that because there's just a ton of retail demand that's like, I just want to own these assets, and I don't care that I'm paying more of this cost, because to me, I'm like thinking on a long enough time horizon, it doesn't matter. And somehow that the LP mindset is somehow a little bit closer to that. So another thing we do, so we talked about our risk products, but another thing we do at Gauntlet is incentive management. And what that means is, how much should different protocols pay for liquidity incentives? So like SushiSwap, for instance, pays rewards for different pools. And so for instance, we help them manage like how much should they put in each pool. Like you don't want to give a ton of incentive to a pool that has no volume and is a random coin. Whereas you do want to give a lot of incentive to certain pools, but not so much that there's just a ton of capital sitting there relative to the trading volume. So we help them save like $200-300 million of like spend, because they spend a lot of money on attracting liquidity. And the cool thing from that is one of the things we've learned is there really are these like different types of liquidity providers. There's really like the never touches they put it in and they haven't done an interaction in their wallet for a year. And then of course there are people who have made these sort of farming funds that are constantly churning through. And there's a spectrum between those. And I think, this is why I think the types of things of like simulating the users in these systems to understand, what the incentive should be or what the risk parameter should be is kind of powerful. But it also kind of says something about the nature of these LP shares, which is that they really do have this like passive to active spectrum that is.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.